Chapter. We're talking real money.
What a week. What a week. Holy mackerel. What a week this has been. And, Tom's deserted me too. Hi, everybody. Don McDonald. All alone today. Well, except for you, of course. You're there, I hope. Talking about money. Things that involve money. Money-oriented topics of sorts. And there's a bunch of them that we can cover. But again, as we say every week, we want to defer to you first. And the way we do that is by you calling us at 855-935-TALK, 855-935-8255 every Saturday, because that's when we get to actually have a conversation. And today's conversation will be just between you and me. Just two people. Because today, it's just me. Tom decided to fly to Las Vegas. Now, if you're a regular listener to the show, you'll know why Tom chose to fly to Las Vegas for the weekend. And it's not for the gambling. No, his football team is there now. Not mine, his. So he's there. And of course, get this. Are you ready for this? He left me to go to a game. And today is my wedding anniversary. So my wife is over at the Grand Floridian Resort hanging out, where we're going to hang out for the next couple of days to celebrate our 33rd wedding anniversary at the place where we got married. We were, although they won't officially admit it, we were Disney's first official wedding. We got married in 1991 before they started the multi-trillion-dollar wedding department. Okay, I exaggerated a little bit. I was doing my show, the Don McDonald Show, out of Disney MGM Studios, now Disney's Hollywood Studios, and we had family all over the country, and we said, well, why can't we just get married here since we're at Disney all the time? I mean, we were there on press events regularly, and they said, no, you can't get married at Disney World, and we went, well, that's kind of silly. Why not? You don't have a good reason. So they said, well, we'll try it. We'll run it through conventions. We'll try it out. We'll see how it goes. And so we did it at the brand new Grand Floridian Conference Center out on the patio. And it was a gorge. I mean, it's Disney. They did an incredible job. We had a great place for the ceremony. We had 75 people there. We had an incredible reception. The food was out of this world. Open bar, flowers. They even brought a horse-drawn carriage for us to pick us up and take us right back to the main building at the Grand Floridian, where we had our suite that they gave us. And the whole bill to my father-in-law was just a bit over $8,000. That's real money. That's not real money anymore. I mean, that kind of a wedding, probably be $50,000. I don't know. I don't know what they run, but it wouldn't have been cheap. So, and then to top everything off this week, we had another very expensive experience for the state of Florida. Thankfully, not for us. And that was Milton. Whoa, what a day Wednesday was. Wednesday into Wednesday night, early Thursday. Whew, we had some hellacious winds, an incredible amount of rain. But again, this is for Debbie and me. This is I don't know, probably like 10 or 12 hurricanes that have been in the vicinity. Several of which crossed right over our house, right over the top of it. And we've sustained almost no damage because the community in which we live is really, really, really well built, great drainage, underground power. And so we're super lucky, but we do feel for everybody who's not super lucky. And there were a lot of those. It was a really bad, it was a bad storm even for us, but we didn't have damage. And again, I'm so grateful for that. But, if you haven't been through one of these, they're pretty scary. They're loud. They're obnoxious. So anyway, that's what's going on with me. You are invited to call me at 855-935-TALK, 855-935-8255. And coming up, I want to talk a little bit about hurricanes, but hurricanes and stock markets and how to predict them.
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to the Talking Real Money program, and then next week it'll be a podcast. Hi, everybody. I'm Don McDonald. Thank you for being there. I am here. Tom is not. You are there. I hope you join me. 855-935-8255 is the phone number. That's 855-935, and it just spells talk to make it easier to remember. So call me, and let's talk. Since we had here in Florida a hurricane last week, and then much of the southeastern part of the country had a terrible one 2 weeks prior, I wanted to compare something. Of course, when you have a hurricane coming your way, you tend to watch a lot of weather. The Weather Channel, the local news, of course, because they love to panic you. But I noticed something really, really interesting with these last couple of hurricanes. One of the things you'll see in the forecasts is the spaghetti models. These are various computer models that predict the path of the storms. And I noticed recently that these things are all starting to line up, and they're becoming pretty accurate. There were times when we were surprised. Suddenly a storm would turn. I remember one that hit us, went out in the ocean, came back and hit us again, and they went, well, they just don't do that. They did. But what I wanted to do was really look into the predictive process for hurricanes, because I'm in a business where there are lots of predictions made about the markets, interest rates, but particularly the stock market. What is the stock market going to do in the short run? Just the whole market. Let's not even talk about individual stocks. We're going to get into real complexity. But let's think about the hurricane forecasting process. What has really, really made for accurate hurricane forecasting is the use of supercomputers. They have really changed things, because what you are able to do is input a variety of parameters into the computer, and the computer then can compare those to things that have happened in the past and run simulations and do a lot of this in a very short period of time. It would take humans a lot of time to do. And they come up with a consensus as to what's going to happen. And it's based on a relatively few things when you think about it. I've done a lot of reading about it, and most of it is basic physics. Heat rises. The Coriolis effect, where when things spin in the northern hemisphere, they spin counterclockwise. So certain things are going to happen, that you're going to get a spin when hot air is rising. Then you've got to have that the spinning of the atmosphere, and then that spinning of the atmosphere along with the various currents in the atmosphere, the interaction between high and low pressure, the jet stream, the currents in the ocean, all of these things are relatively known quantities, and they can feed this information in. And for example, with Milton, it was moving because of the spin and because of the hot water in the Gulf of Mexico caused it to spin up really rapidly to a Category 5. But then as it got closer to land, you had the wind coming off of the continent, coming down in a cold front, which is falling south. That was ripping off the tops of the clouds, causing the storm to get smaller. And they very accurately predicted not only where it was going to go, but what size it would be along the way. And then when it gets to land, when it hits the land, it actually encounters the friction. The water's slippery. Land is not. It's sticky. So that causes the storm to spin down, which is why we only had 100-mile-an-hour winds instead of 140, 50-mile-an-hour winds here in the central Florida area. So all of those things allow the prediction of the market, but in large part, it's because there are not very many variables, and the variables are easily calculated because they're based on science fact. Problem with predicting the stock market is it's not based on physics. It's based on physics with an F. Okay, plug for my book, Financial Physics. Because there are no physical forces that act on the stock market. What forces act on stock prices? Us. We do. Each and every one of us. And we as individuals are not predictable. We are, in fact, I think you can make a very good case that we are not even logical. And we have so many psychological biases that calculating all of those involves numbers. Well, when in the United States alone, there are about 160 million people invested in equities in one way or another. And then you got that multiply that by the population of the world. And so you've got hundreds of millions of people who are all acting in various ways depending on what they want, what they need, how they're feeling, what their expectations are, their personal frame of reference, their political bent. You've got so many variables in this vast quantity of variables, which are human beings, that the math has got to be close to impossible given current limitations. Now, quantum computers, maybe someday they'll be able to actually take each of our individual biases into account and come up with some sort of a predictive supercomputer program, quantum computer program. But for now, you can't. And the reason, it's hard to predict hurricanes, and they have a limited number of factors, and most of those are based on hard physics that scientists truly understand. And yet they can tend to be unpredictable, a little unpredictable. The reason the stock market won't be predicted anytime soon with accuracy and consistency is because there are just too many variables to calculate. So what does that mean for you? That means that the markets will never do what you expect them to do all the time. And if you do predict the markets, you have a limited amount of information on which to make those predictions, on which to base them. So you can't do it. You as an individual can't do it. You're only lying to yourself if you think you can predict the markets or individual stocks, because you cannot do it. However, again, in a world of millions of possibilities, there's a lot of room for luck. A lot. And our psychological problem is that we often confuse luck with skill because of our egos. We think we're better, we're smarter, and we're not. And so if you can learn something from hurricanes and the difficulty in predicting exactly where they're going to go and when they're going to get there, well, then you should understand why it is impossible for anyone to predict where the stock market is going to go. The only thing you can know with some semblance of certainty is that if the world doesn't end, the human economy will probably do what it's done for thousands of years, and that is continue to grow. And that's a factor in your favor, because that means if you invest and stay invested, then your chances of success are pretty good, and you don't even have to fool yourself into believing you know the future. 855-935-TALK. Call now.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Well, today it's just Don talking real money. Tom is on his way to Las Vegas. As soon as I get done with the show, I'm on my way to celebrate with my wife. 855-935-8255 is the phone number, 855-935-TALK. And Valerie, it's your turn. Thanks for calling and welcome to the show.
Hello. I wanted to say happy anniversary.
Thank you.
That's exciting.
Thank you.
And so earlier this year, I did your guys' advice, and I got out of my American funds, and I opened up my own Charles Schwab account, and I was able to figure out how to automatically take the money out of my bank account and, get it in there for my Roth IRA. And now my issue is, and I've been buying the AVGE stock, right? Because that was recommended.
The Total World Avantis ETF, yeah.
And my question is, sometimes the price of the stock is $77. Sometimes it's $69. And then it also says that I can pick my own price. And my problem is, sometimes I have enough for my monthly allotment to do 2 shares. Sometimes it's only 1 share. And I don't understand this process of buying the stock.
Got it.
Am I supposed to go for the lowest price possible?
No.
It's very confusing.
Yeah, it is very confusing. What I would suggest, and what I suggest to everybody, is that you put your order in at market, at what the market price is. There is let me go back, because this is a sort of a process. AVGE is an exchange-traded fund, which means instead of being a normal mutual fund, it is a mutual fund that trades on a stock exchange. So it trades like a stock, which means it has a bid and an ask price. The bid is the price at which people are trying to buy it. Doesn't mean it's trading at that. That means that's the price people are offering for shares who want to buy a bunch. They want to buy tens of thousands or hundreds of thousands of shares. And then the ask is what people are trying to sell it for. Often they don't get either side of that. There's a bid and there's an ask, and the prices come in often somewhere in the middle. Now, right now, the price of AVGE for, let me pull up the chart for the past couple of months. It has not been in the 50s. Now, yeah, it's about $74 a share, and its bid ask has been in that range, in that 73, 74 area. You really, does it been as high as 74? Hold on, the Morningstar is running very, very slowly. Yeah, lately it was 74. So it's been day to day. It's looking like it's been 73, 74, somewhere in there. And the difference in reality is going to be a few cents, 10, 15, 20 cents a share. So it's not worth kind of waiting around. If you put in a price you put a particular price, you may not get your stock, because you may be too low.
Yeah.
So it's better just buy at the market. Just buy at the market, because we're playing the trend. And the trend for the stock market has so far, for the past 100 years almost, been positive. Not daily positive, but year to year to year to year to year, generally positive. Which means, for example, if you bought AVGE when it came out back in 2022, you paid $50 a share. Today, it's 74.
Yeah.
So you want to just buy it at whatever the price is, because let's say back in 2022, you put in a bid at $49 a share. It would have never filled. You wouldn't have gotten the stock because you wanted to wait for a better price, and that price, it never hit that price.
So the money just sits there. You don't actually...
It doesn't work for you.
No man's land.
It sits there in cash making nothing. So the trick is to always put in a market order on all of the things we talk about, because they're widely traded, which means the spread minute to minute is going to be very small. Very, very small. The only time the spread is wide is when you have a very lightly traded stock or a very lightly traded ETF, and we wouldn't recommend those because those tend to be niche funds or actively managed, and we don't want you in those. So for an AVGE, bottom line, market orders. Thanks for the call.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
The show, I'm Don. Tom's taken the weekend off, and I'm so glad that I get to spend a little time with you, because this is when I get to talk with you at 855-935-TALK, 855-935-8255. Give me a call. It's really easy. And Craig did just that. Hey, Craig, welcome to the program.
Hey, Don, how you doing?
Good, thanks, Craig. What's up?
Well, so I'm kind of piggybacking actually on your answer to a question yesterday, but now on the last caller as well. So I was wondering about the bid ask as well, and partially because I was explaining to somebody or talking to somebody and comparing Vanguard and Avantis, and we were looking at Vanguard funds, and their bid ask spread is usually 1 cent to 2 cents, whereas Avantis is always 10 to 20 cents, and it's never, I've always done market orders. It's never changed, but I couldn't intelligently explain what drove either number. And I was hoping you could give me some explanation like I'm for, so that I could, in turn do the same.
Absolutely. And the difference, as I explained, I think before, is volume. It's all trading volume. Yeah. The Vanguard ETFs like VT. In fact, I let me see if I can pull up its volume. And I apologize. I look everything up on Morningstar, and lately my internet is fast. I mean, it's really fast. So it's not my computer. But their servers are really slow. The volume, like the average volume on AVGE, is about 26,000 shares a day. I mean, that's good volume. But
sure,
when you compare it to VT, which I'm trying to pull up, there it is, Vanguard Total World Stock Index, slowly loading. So I have to do a little bucking and winging here as we wait for it to slowly load, and then for that little category to fill in. Come on, Morningstar. Really, guys? If anybody from Morningstar is listening, your servers are so incredibly slow. It's time to invest in new servers. Here we go. So we're talking 25,000, which is respectable. VT has daily volume, on average, of 1.3 million shares.
Good Lord.
That's the difference. I mean, that truly...
So kind of related, and this has happened to me a few times now, and it's buying Avantis funds. I'll put in I always do market order, and Fidelity will come back with a notice that it's been partially filled. Does that have anything to do with the bid ask, or why would that happen? Because it's not infrequent.
It's not really. I have never had a partial. I've gotten, I mean, back in the day when I used to be a broker, I would get partial fills when we would put in a limit order. But on a market order, what it probably meant was there just wasn't an active ask at the time.
Okay.
So they have to wait.
So it is somewhat related.
So, gotcha. They have to wait for someone, because I know with individual stocks we would get that because there was no one at that price. And again, just to put all of this in perspective, one of the highest traded stocks in the world is Apple. So we have the Avantis Global Fund, AVGE, at about 25,000 shares a day. We have the Vanguard Total Market Index ETF at 1.3 million shares a day, and Apple at 52 million shares a day.
Good Lord.
So you see the differences.
So if it's yeah, absolutely. That explains it. So if it's partially filled, when when the other part gets filled, are you paying a different price, or are you locked in at when?
Nope, you're paying. You'll be paying a different price unless your order is all or none. And this is getting into terminology I have not used. Literally, I have not used in 20 years. Because that was back in the days when we'd do limit orders and stop orders and all or none is when you put in an order at a price and you say fill all or none at that price. So if you have a market order in, and let's say your market order fills at 74, and then the next shares that come in, the next seller comes in at $74.25, you're going to get $74.25. For your next purchase. So it's gonna depend on
Thanks so much, Don.
What's going on the other side. Thanks, Craig.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Hey, welcome back to the show. Sorry we had a little technical problem, which I'm going to be getting upset with someone about soon at Tie-Line. My Tie-Lines, I have this device. It's called the Tie-Line. It connects to another Tie-Line in Seattle. And when it works, it's absolutely wonderful. But it's been in the shop for ages, and it's still doing the same thing that it was doing. It just locks up and shuts down randomly. Just you can't do anything with it. You have to totally turn it off and reboot it. So that's what I did. Hey, 855-935-TALK is our phone number, 855-935-8255. I want to reiterate something, though, before we get too deep in these weeds with the bid-ask spread. Every stock, everything traded on an exchange has a price at which someone wants to sell it and a price at which someone wants to buy it. That is the bid-ask spread. Now, most of the time when someone wants a transaction has to occur, they meet in the middle. It's a compromise of sorts. Or if you've got a small order that comes in, then it fills at the ask price. If you have a big order that comes in, then they'll fill it at the bid price. So they're always matching these orders up, and it's all done with computers these days. So, but I don't want you to get too caught up in it because, as the callers have said, we're talking a penny to pennies per share. And when you have a $75 stock or ETF, 10 or 20 cents a share is not going to be noticeable. You're not even going to remember that little tiny difference 5, 10, 20 years from now. Your goal is to get invested as soon as you have the money to invest. This should never be a waiting game. You want to invest the money when you have it, not try to pick the right time or the right price. And that should be very obvious in what has happened this week. Look at the stock markets this week. I remember a few months ago, we had people calling, well, now that the markets are at new highs, should I wait until they go down before I invest? Now, this was several months ago. And Friday, markets closed at what? New highs again? Our goal is to always have new highs. That's what we want. And by the way, that's what's happened for about 100 years, is that if you wait long enough, you get another new high. It's just a patience process. 855-935-TALK is our phone number. And Bruce, you're up. Welcome to the program.
Thanks, Don. I've talked to you before. I've talked to Tom before. I think you guys give great advice. I have a general question, and the general question is, I should give some background. I'm 70. I am mostly retired. I'm doing a little consulting, and I have a 50-50 portfolio. And then equities, I have one U.S. fund and one international fund. And bonds is the specific question I want to talk to you about. But in general, what would you recommend as a split between U.S. and international for both equities and bonds?
Well, this is an area where Tom and I have a difference. He believes going with whatever the current global market cap split is, which these days is, I haven't looked in a while, but I think it's below 60-40. I think it's, in the 60 or in the 50 or 60 something, 30 something. I, on the other hand, believe that it's better to go back to what we had for such a long period of time when the two markets were both doing well. And I have a 50-50 split in my equity portfolio between U.S. and international. Because if you look at the rest of the world, it is, in terms of consumers and wealth, very, very similar. The rest of the world, in many other factors, it is similar to the U.S. in size. So that's how and the other thing that I keep looking at, and this is not a market timing thing. I've stuck with 50-50 for over 10 years. More than that. Gosh, I'm getting old. Probably 20 years. The other reason is the fact that the U.S. market, I don't want to up my U.S. allocation just because the U.S. market has done so much better than the international markets. And the last decade, the U.S. market has just soared way above the international markets, becoming a larger market in terms of market cap. So I'm not a big fan of that market cap allocation, but that's me. I'm a 50-50 person. I just think that's a simple number to set for those times when the U.S. market does poorly and the international market does well. You have to rebalance to something. That's what I've rebalanced to.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And that number, again, is 855-935-TALK, 855-935-8255. And by the way, in that international number, I am including emerging markets in there. So it should be the developed markets, emerging markets at 50, whatever that split is. And yeah, I'll go with Tom on the 20 emerging. I think it's risky, but fine. 20 emerging, 30 developed, and then 50% U.S. is what I like to stay with because I've been with that. I've been with that since the days when it was a real 50-50 split between U.S. and international. And so I rebalance back to that because it would seem strange for me to rebalance. Well, I wouldn't be rebalancing. If I let the international portion decline and the U.S. portion grow as the U.S. market has done better, well, then I would be out of balance. That's my weird argument. 855-935-TALK. Give me a call. I've still got an hour on the radio to spend with you, and I hope to spend it with you because Tom's gone, so you're the people I have to spend it with. And just a couple of quick reminders. One, if you want to ask questions and have a conversation, the time to do that is Saturdays from noon to 2 Pacific when we're live on Northwest News Radio. Or 3 to 5 Eastern time. If you have other questions you want to ask outside of that time, you can go to talkingrealmoney.com on the contact form and ask your questions there, either verbally or typing them. And if you need more than just an answer to a relatively quick question. You need your portfolio looked at. That's the kind of thing that's really hard to do in the confines of a radio show or a podcast. You have, stuff all over the place. You have a hodgepodge. And if you want somebody to look at that, we decided a long time ago that we weren't really doing the service we should be doing if we told you that you had to hire us for us to look at your portfolio when you really don't need an ongoing manager, advisor. So we came up with this idea several years ago, 15 years ago, to make our advisors. Sometimes you have to make them spend a little time with everybody who needs that help and do it for free and do it without any obligation and do it without any sales pitch. Our thinking at the time was, hey, this is going to be good for business because if you help a bunch of people free, it's karma marketing. And turns out it's been really, really successful. So it's gotten us a lot of business and it's gotten you guys a lot of free help. So go to talkingrealmoney.com and click on that button there that says Meet an Advisor. Am I early? I am a minute early. Oh, I was looking at the seconds on the clock. I forgot to look at the minutes. So again, go to talkingrealmoney.com. By the way, for a lot of other stuff too, we've got a bunch of articles. Back in the day, I used to publish a magazine called Real Investing Journal. It was actually a glossy magazine, and it just turned out to be really expensive, so we stopped doing that. But I put all the articles from that up on talkingrealmoney.com. So there are hundreds of really great informational articles there too, in addition to all the podcasts and information on how to find an advisor. But once again, if you need some help, it's so easy to do. Just go to talkingrealmoney.com, and right there at the top, I put all the buttons there so you can easily find them. You can contact us there or click Meet an Advisor.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.